employee compensation, post-employment, and share-based. If you do get a question on pension accounting, it is very likely that you will be asked to calculate the total periodic pension cost. And you must remember this formula. The total periodic pension cost is equal to the change in net pension liability plus the employer contribution. And by now you must know that a change in something means the ending value minus the beginning value. So let's look at a simple example. We are given the present value of the defined benefit obligation at the end of 2014 and end of 2015. Similarly, we are given the fair value of plan assets at the start of 2015 and end of 2015. So these are end of year numbers. So 80 over here means beginning of 2015. And for your convenience, we are also giving you the net pension liability or the funded status. So at the end of 2014, we have a net pension liability of 20, and at the end of 2015, we have a net pension liability of 23. Here we are assuming that the employer contribution is 0. So the total periodic pension cost is the ending value 23 minus 20, which is equal to 3. So the total periodic pension cost is 3. Here is another scenario where we've not been given the funded status. So we need to calculate the pension obligation at the start of the year. So we are taking 2015 again. So at the start of 2015, the net pension liability is 10, and at the end of the year the net pension liability is 5. The employer contribution in 2015 is 2. So we don't consider the employer contribution in the previous year. Certain benefits are paid, but in our calculation we do not consider the benefits paid because these impact both the obligation as well as the plan assets. So just remember this expression. The change in net pension liability is the ending value, which is 5, minus the beginning value, which is 10, plus the employer contribution, which is 2. So here we'll have 5 minus 10, which is minus 5 plus 2, and this is equal to minus 3. Which means that the cost is minus 3. A cost of minus 3 really means a pension income of 3. Here is a third scenario, and again we can use the same formula, which is change in net pension liability plus the employer contribution. So what is the pension liability at the start of the year? In this case, the fair value of plan assets is actually higher. So we have a net pension asset of 10. If we express this as a liability, that is going to be minus 10. What about at the end of the year? Again, the asset is more, so we have a net pension asset. In terms of liabilities, this can be minus 5. So we are going from minus 10 to minus 5. The change is the ending value, which is minus 5, minus the beginning value, which is minus 10, plus the employer contribution, which is 2. So we can do our basic mathematics here. Minus 5 minus minus 10, which is plus 10, and then plus 2, this gives us 7. So the total periodic pension cost is 7. Now sometimes in the curriculum you'll see a different convention. If we take assets as positive and liabilities as negative, and we take any inflow or income as positive and expenses as negative, then the formula can become the pension income. So the total income is equal to the change in net pension asset minus the employer contribution. So over here, what is the change in net pension asset? We have an asset of 5 at the end of the year, minus we have an asset of 10 at the beginning of the year. So you have 5 minus 10, minus the contribution, which is 2. So 5 minus 10 minus 2 is minus 7. The pension income is minus 7, which means that the expense is 7. So these are just two different ways of looking at the same problem. I would prefer that you remember this formula, that the total pension cost is equal to the change in net pension liability plus the employer contribution. And I say this because generally most plans are underfunded, so we typically have a net pension liability at the start of the year and at the end of the year. Now let's look at this example. We have a company which follows IFRS, and we are given the different components of the periodic pension cost. We are also given a reconciliation between the pension obligation at the start of the year and the end of the year. Similarly, we have a reconciliation between the fair value of plan assets at the start of the year and the end of the year. First question is, what is the funded status at the start and end of the year? So the funded status is simply equal to the obligations minus the fair value of assets. So we have a present value of obligations equal to 30,000, assets are equal to 25,000, the liabilities are more. So at the start of the year, we have a net pension liability equal to 5,000, and at the end of the year, we have a net pension liability, which is this number minus this number, which is 4650. So over the year, the net pension liability actually comes down. Next question. What rate is used to calculate the net interest expense? Now you might recall from our IFRS discussion earlier that the net interest expense is equal to the net pension liability times the interest rate. In our case, the net interest expense is given, this is 250, and the convention we are using is that the expenses are shown as positive numbers and any income or gains are shown as negative numbers. So the net interest expense is 250. This is equal to the net pension liability at the start of the year times the interest rate. So the net pension liability at the start of the year is 5,000 that we calculated earlier. The interest rate is what we need to calculate. So the interest rate is 250 divided by 5,000, which is 0.05 or 5.0%. What does remeasurements include? Now again, recall from our earlier discussion that remeasurements has two components. One component is the actuarial gains and losses. The other component is the actual return on plan assets minus the plan assets into the interest rate. We are told that the actuarial gains here are 0. So there are no gains or losses. So in our somewhat theoretical example, this is 0, though in the real world this is seldom 0. The entire remeasurements then in our example is this component. And we are shown that number, minus 150. A minus here means a gain. Since the service cost and net interest expense are shown as positive numbers, the remeasurements is negative, which means that this is positive. So let me show you where this 150 number comes from. If we look at the plan assets or the change in plan assets, one of the items here is the actual return on plan assets. So this actual return number is 1,400. The plan assets at the start of the year were equal to 25,000. So you have 1,400 minus 25,000 into the interest rate, which is 5%. So when you do this calculation, you will get 150. This is a gain of 150. The actual return was higher than this number. So this is going to reduce the overall pension cost. And let's look at the numbers here. The service cost is 250, net interest expense is 250, so this is 500. This gain is going to reduce the pension cost, so we subtract 150 and we have 350. So 350 is our total pension cost, and the question was, what does remeasurements include? Remeasurements basically includes this number. Next, what is the actual rate of return on plan assets? Here we are asked for the rate, and this is very simple. We are told that in dollar terms the return is 1,400. The initial value of plan assets was 25,000. So 1,400 divided by 25,000 is 5.6%. Next, which cost components are shown in P&L and which are shown in OCI? Now again, go back to our discussion on IFRS. Service cost is shown under the P&L. Net interest expense is also shown under P&L. So these two components are shown under the profit and loss statement. So in the P&L, our pension expense is going to be 500. Under remeasurements, we show minus 150, and on the previous slide I talked about where we come up with this number. So this is actually a gain in OCI. What is the total pension cost for 2015? So one way of coming up with this total cost is simply adding up the numbers, and that gives us 350. But I also want to show you the other method. As discussed earlier, the total pension cost for a period is equal to the change in net pension liability plus the employer contribution. The net pension liability at the end of the year is 4,650. The net pension liability at the start of the year was 5,000. And then you add the employer contribution, which is shown over here. That contribution is 700. So add that, and what you will get is 350. So this is the total pension cost for the period. As I discussed earlier, you can use another method also. If we say that assets are positive, liabilities are negative, income positive, expenses negative, then the ending funded status is actually a negative number. So since we have a net pension liability, and if we are saying liabilities are negative, then we can say minus 4,650 minus the beginning funded status, which again is negative because it's a liability, so minus 5,000, and then minus 700. So this is going to give minus 350, and in this convention an expense is negative, so minus 350 means an expense of 350. So either way we get the same answer. We will now look at an example which compares IFRS and US GAAP. Let's say that for a given company we have this data, and this is data for 2015. We are told that in this year the employer contributions were 3,000, current service costs 600, and so on. We are also given the pension obligation at the start of the year, at the end of the year, the plan assets at the start of the year, end of the year, and so on. The first question is, what are the retirement benefits paid during the year? And this number would be the same for both IFRS and US GAAP. Then we need to show the reconciliation between the benefit obligation at the start of the year and the benefit obligation at the end of the year. This is similar to something we saw in an earlier example. So what I want you to do is say that the pension obligation at the start of the year is this much. Then what are the various numbers that take us from here to here? Question 3 asks about the reconciliation with respect to plan assets. So how did we go from here to here? Then you are required to calculate the total periodic pension cost. Question 5 asks you to show the allocation of this total cost between P&L and OCI under IFRS, and then what is the allocation between P&L and OCI under US GAAP. With US GAAP, make the assumption that if any cost can be allocated to either P&L or OCI, then it is being allocated to OCI, and let us ignore any amortization of expenses from OCI into P&L. So try this before you move on. Now I'll help you with the first question, which is what was the benefit paid by the company during this year? To do this, you can either take a liability approach or an asset approach. So let's say that the beginning pension liability is shown right here. So that's this number, 176,400. Then what are the various items that will take you from here to the ending liability? You are going to add the current service costs, then the past service cost, then we have the interest cost. Now the interest cost is not explicitly given, but we do have the discount rate, which is 8%. We do have the pension obligation at the start of the year, so you can take 0.08 times this number, that's the interest cost. Then we have the benefits paid. So the benefit paid will actually reduce the liability. So you can say minus the benefit paid. And then we have an actuarial loss. An actuarial loss increases the liability. So we can add the actuarial loss. And when we do this maths, what we should end up with is the pension obligation at the end of the year, which is 175,560. Of all these numbers, the only one that we do not know is this benefit paid. We know the beginning liability, we know the current service cost, we know the past service costs. I just told you how to calculate the interest cost, which would be 8% into this number, and then minus some benefit paid plus the actuarial loss, which is this number, gives us this. So through algebra, we can calculate this number. And here I will show you the numbers. So we have this. The benefit paid is a plug because all other numbers are known. Now this is shown as a negative, which means that the benefit paid actually reduces the liability. So when you solve for this number, you get minus 17292. Another way of calculating the benefit paid is through the assets. Initially, the fair value of assets is this much. We are given the actual return, which is increasing the value of assets. The employer contribution number is shown, so that also increases the value of assets. The benefit paid reduces the value of plan assets, so that's why we have a minus. And then the fair value at the end of the year is given. So again, we could calculate this using algebra. Alright, now you need to also answer these questions, and they should be straightforward. What's the funded status at the start of the year? What's the funded status at the end of the year? So for start of the year, you look at the pension obligation at the start of the year and the plan assets at the start. So clearly this is very underfunded. So we have a net pension liability, which is this minus this. At the end of the year, the net pension liability is this minus this. What is the total periodic cost? That is going to be the change in net pension liability plus the employer contribution, which is 3,000. Then the pension cost under P&L. So we need to remember which components are reported under P&L under IFRS, what is reported under P&L if this company were following US GAAP, then what is OCI under IFRS and OCI under US GAAP. And here we are assuming that if a company has a choice between categorizing a cost or an expense under P&L or OCI, here it is going to categorize under OCI. So let me show you the numbers. The funded status at the start of the year, as I said, is the difference between this and this, which is 59400. The funded status at the end of the year, you should get this number again, the difference between assets and liabilities at the end of the year, and these are both net pension liabilities. What is the total periodic cost? So that is the change. So it's going to be this number 64,752 minus this plus 3,000. So that's the total periodic pension cost for the year. Then what is the pension cost in P&L under IFRS? So remember, under IFRS we are going to have the entire service cost, and under IFRS we don't really distinguish between current and past. So we are going to have 600 and 360. Then we are also going to have the interest cost, which is 8% or 0.08 multiplied by the pension obligation at the start of the year, which is this number 176,400. So we add all these together and we should get the pension cost under IFRS, which is 5712. Then the pension cost that is shown in the profit and loss if we were using US GAAP. With US GAAP, only the current service cost is shown in the P&L, so we have 600. Then we have the interest expense, which is going to be 8%, 0.08 multiplied by the pension obligation at the start of the year, which is 176,400. And from this we subtract the expected return on plan assets. So we are going to subtract 10%, which is 0.1 times the plan assets at the start of the year. The plan assets at the start of the year equal 117,000. This plus this minus this should give us 3,012. So this is an expense. Notice that here the pension expense shown in the P&L is higher under IFRS than it is under US GAAP. Next, OCI under IFRS. So this has two components. One component is the actuarial loss. So the actuarial loss is 1380, and then from this we subtract the actual return minus 0.08 times the plan assets at the start of the year. So the actuarial loss is 1380 minus the actual return is 8100 minus 0.08 times the plan assets at the start of the year, 117,000. So when we do this calculation, we should get 2640. Pension cost in OCI under US GAAP. This is going to include the past service cost of 360. There is going to be the actuarial loss of 1380, and then we subtract the actual return, which is 8100, minus 10% of this number, 10% because the expected rate of return on plan assets is 10%. So minus 0.1 into 117,000. So this gives us 5340. So far we have talked about the allocation of pension costs between other comprehensive income and the profit and loss statement. Now we will look at the classification of pension costs which are recognized in the P&L. Pension costs are shown as operating expenses. However, the interest component and asset returns are non-operating. So we need to make an adjustment. The adjustment is that we should show service cost as an operating expense, and we should add the interest component to the company's interest expense, and we should also show the return on plan assets as a non-operating interest income. Let's consider a very simple example. We have a company which follows US GAAP, and it has this income statement. We also have a pension disclosure which says that the current service cost is 5. So the brackets means that it's a cost. The interest cost is 2. The expected return on plan assets is 6, but the actual return on plan assets is 8. So what sort of an adjustment do we need to make? And specifically, what is the profit before tax if the actual rather than the expected return on plan assets is used? So let's start doing this. The difference between 6 and 8 is 2. So very easily we can say that the actual return is 2 more, so the profit before tax needs to be 2 more, which is going to be 61. Now let's look at the specific or the individual line items. What is the operating expense if we do make these adjustments? Currently, these 3 items which are part of the profit and loss statement, so these collectively become the pension expense, and we have a pension expense of 7 and then a return of 6, so the overall pension expense is 1. And if we are using brackets for negative, the pension expense is -1. If we pull out the pension effect from the operating expenses, then the operating expenses will be -39. And then we say that the only expense that we want here as an operating expense is the service cost. So that service cost is 5. Then the operating expense will become -44. So we have pulled out the interest cost and we pulled out the expected return on plan assets. The only thing that we are left with is the current service cost. The EBIT then becomes 56. Now what about the interest expense? The interest expense was 2. We pulled that out of operating expenses, but that interest expense now needs to be added over here. So the interest expense now becomes 12. The interest income needs to be adjusted. Originally it was 9, and then we add 8 because the actual return on plan assets is 8. So the adjusted interest income is 17. Now if we add these numbers, so we have EBIT of 56, take out the interest expense, add the interest income, we end up with a profit before tax of 61. Now work through example 5 in the curriculum. Next we deal with adjustments related to cash flows. Here are the 2 key points. If a firm's contribution exceeds the economic pension expense, this is a form of repayment. On the other hand, if a firm's contribution is less than the economic pension expense, this is a form of borrowing. Here I use the term economic pension expense. This is the same as saying total pension cost, which includes both the P&L component and the OCI component. Let's take a very simple example. Say we have a total pension cost during a given period of 100, and the company contribution during this period is 120. The tax rate is 25%. Normally, a contribution by the company is shown under cash flow from operations. However, if we have a pension cost of 100, a total pension cost of 100, and the company is making a contribution of 120, the extra 20 is reducing the pension liability. So since the pension liability is being reduced, the 20 should really be categorized under cash flow from financing. So 100 should go to CFO and 20 should go to CFF. These numbers are on a before tax basis. If we have a tax rate of 25%, then on an after tax basis, we'll have 20 times 1 minus 0.25, which is 20 into 75%, 15. So on an after tax basis, the adjustment needs to be 15. So this 15 before adjustment was shown as an outflow in the CFO segment, but it needs to be moved to the CFF segment. If before the adjustment the inflow was 300 and then this 15, which is a minus or an outflow, if this is being removed from CFO, the CFO is actually going to go up. So from plus 300 we go to plus 315. The CFF before adjustment was an outflow, so it was minus 200, and since this 15 is going out now and it needs to be categorized under CFF, we subtract 15 and we end up with minus 215. So after adjustment we should show an outflow of 215. Now I want you to work through example 6. If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.